An investment vehicle I get a lot of questions on and use frequently with my clients is a structured note. A structured note is an investment issued by a big bank and may be ideal for an investor who wants exposure to an equity index but wants to reduce some of the volatility of owning that index. If you're new to this concept, please see my video, What is a Structured Note? I'll put the link in the description. That video is the 101 course. This is the 201 course. There are three types of structured notes: growth, income, and principal protection. There will be a video for each style and the links will be in the description. For this video, we're doing a deep dive on income notes. Here's our agenda: a brief overview of income notes, then we'll examine a real offering for a note offered in 2022. Then I'll hit the whiteboard so you can see an example of how this type of growth note plays out in a real life example. Here's an easy way to understand the difference between these notes. If you want more expected return, as evidenced by this green circle, then you're going to be doing a growth note. If you want a higher level of risk, as evidenced by this red circle, then you're going to be looking at a growth note. If you're okay with lower returns in exchange for less risk, then you'd be on the other end of the line here with the principal protected notes. Income notes provide an investor with the opportunity to receive above average periodic income payments. The upside potential on income notes is simply the coupon yield. The principal is usually protected up to a certain downside barrier or level of an underlying equity index. An income note is not a substitute for a bond, but it can provide some diversification benefits to a bond allocation. Specifically, it generates income without assuming interest rate risk. The risk to principal occurs if a trigger event happens. The low frequency of barrier breaches at the 30% level might suggest that there is an unlucky factor at play. A prudent way to mitigate the unlucky factor would be to build a ladder of income notes. These are the final terms for an income note that closed on February 11, 2022. So what we'll do is walk through the specifications here, and then we'll go to the whiteboard, and I'll show you an example with some real numbers. So the pricing date on this note is February 11th of 2022. This is the CUSIP, so every note has its own unique identifier known as a CUSIP. The pricing date is February 11, 2022, Bank of Montreal, and the closing date is a year out. So this is a 1-year note. Now, this is what's known as a European style note, and I will at some point do a video describing the European style versus the American style. But for now, let's consider this a European style note, and when I get to the whiteboard, you'll have a greater understanding of that. The interest rate is 11.08 for a European style, the annual interest rate. It's pretty good. And the reason is because if you look at the stock market around this point in time, there's a lot of volatility. And when there's more volatility, these interest rates go up. They're actually better to buy when there's volatility, which I'll explain at some point, but it's actually a good interest rate. The interest is paid monthly. You get the interest paid monthly. Now, these notes have something called call dates. And the first call date is in 6 months, and then there's a call date every month thereafter up until the 12 months. What happens with the call date is, so let me explain it this way. See these initial values: S&P 4418, Russell 2000, NASDAQ. So these are the three underlying indexes that are being followed. So what is this call date mean? If on August 11th, the worst performing of these three indexes is greater than this initial value, the note is called, which means they put the money back in your account, and then they're going to give you, if it's 6 months out, they're going to give you half of this, right? So this is an annual rate. They would give you 5.54 interest on your money for 6 months. Again, it's still this 11.08 monthly interest number. I'm sorry, yearly interest number, but you're going to be paid over 6 months. And then there's another call date after that, September 13th. So roughly, 30 days or 1 month later. And then again, now, if the worst performing index is lower than these initial values, it's lower than the initial value, then the note stays out for that additional month. Then they do the same thing on September 13th. Right? Is the worst performing index greater than the initial value? If it is, they're going to call it, give your money back, you paid in full on interest, and you live to fight another day. I will show more of this when we get to the whiteboard. Trigger value, 70% initial index value. So what we are looking for with the European style note is that, so we have the upside, the max upside for a year is this 11.08. If the indexes fall hard, we have the risk of some principal loss. So in other words, if the worst performing index was lower than 70% of the initial value, because remember, it's 70% here, so if it's a 30% decline, then we have the risk of some principal loss. And I will show you how that works when we get to the whiteboard. Do you think people like our videos? Beats me. How do we find out? We can ask them. How? Like this. If you like our videos, give us a thumbs up below. Anything else? Yes, subscribe. This way you'll see our content right away. Tell the viewers why we do this. To help them create safety, simplicity, and most of all, financial strength in the future. Got it. To subscribe, just click the button below. Now back to our regularly scheduled. Let's continue on with this analysis on the income note. This is a 12-month income note, and the interest rate is 11.08%. We're going to use $100,000 just because it's a round number, easy to compute things. So I put up here on the board, here's where the S&P is, and this is actually this is accurate information, historical information. The S&P on the close date was 44.18, 20.30 for the Russell 2000, and 14.253 for the NASDAQ. Now, the way these instruments work, it's the worst performing. So I'm just going to choose the NASDAQ as the worst performing for this example. For 6 months, nothing really happens. We collect interest, so 11.08 on $100,000 is $923 a month. So March, April, May, June, July, August, we're going to get $923 a month. Super simple. And then at the 6 month, there's going to be what they call an observation of where the indexes are. So this is going to be scenario A. Scenario A is the worst performing index is higher. So if you can see here, 4,600 over that, 2,200 over 2030, and 14,254 over 14,253. I just did it like that for a reason, $1 or 1 point. So this note is going to be called, which means that they're going to put the 100 grand back into your account. You're going to be paid in full for 6 months of interest, and we live to fight another day. That's scenario A. Scenario B is that this S&P is higher, 2,200 is higher, but the NASDAQ is actually a little bit lower, 14,200 versus 14,253. In that case, the note is not going to be called. It's going to go out another month. So we're going to go out to September, and they're going to do the same observation. Either we've recovered here on the NASDAQ, and the worst performing is higher than the pricing date, and then the note gets called, or it goes out for another month. And we do this every month until the 12-month anniversary. And I'll show you what that looks like in a second. Okay, so let's continue on with our example. We're going to assume for this that the NASDAQ, which is our worst performing index, was never higher. So the note stayed out for 12 months. And we collected interest all the way through February for the 1 month term, $923 a month, which is $11,080. So that's the interest that we collected. Now, so what can happen at the maturity date? There's going to be 3 options. In option A, we're going to say that the S&P is a little bit higher, the Russell's a little bit higher, the NASDAQ is lower. But here's the magic number for the European style note. It's 30%. 30%. As long as we're above that 30%, then we've just collected the interest and everybody is happy. So let's say in this case it's a 12,000, right? So that's not 30% down. So we're just going to collect the interest, they give us our money back, and we live to fight another day. Let's talk about scenario B. Again, S&P right here, Russell right there. But in this case, we're at 99.77. That is exactly 30% lower than this initial number, 99.77. But because we are at that number, we are going to get our $100,000 back, and we collected the interest of $11,000 over the term. Another positive outcome. What is the negative outcome? The negative outcome is that this has fallen so much that it's actually 35% lower than this initial value. Forget about these don't matter. This is 35%, so it's at 92.64. So in this case, we have lost some principal. We've lost $35,000 on the 100,000 because we're 35% lower. Now, keep in mind that we have collected $11,000 of interest, so our break even, our overall loss really isn't as extraordinary. It's not a great day, but don't forget we got the interest every month as we went along. Here's what I'm going to tell you. I never allocate more than 10% of the structured note budget to a specific note because I don't want this to happen. We can be unlucky
right? And I don't want bad luck to cause somebody to lose a lot of money. So I never allocate more than 10%. 10%, 10%, 10%, because I want to get different market levels, different interest rates, different times a year, and the like. I want to use some growth notes, I want to use some income notes, principal protected notes, but I don't want to put all my eggs in one basket.
Okay, I hope that was helpful. Please remember these videos are for informational purposes only. If you're interested in this concept, you should work with a fiduciary advisor who is legally obligated to work in your best interest, certainly before you make any kind of decision. If you have questions or comments, feel free to throw them in the comment box below and I'll answer them. Thank you for watching.